Welcome everybody to this latest Fed chart book. This is Axel Merk, the President and Chief Investment Officer of Merk Investments. As a reminder, the PDF version of these chart books is available at merkinvestments.com/research. Also, the driving force behind these chart books is Nick Rees, our Senior Financial Analyst. He puts these together. His goal is to give you an unbiased, at least to the extent possible, path as to how these charts evolve. He tries to be consistent and is trying to give them as little bias as possible so that you're not as much subject to the clickbait of headlines that you see. My take in giving you my feedback on these charts is to give you a little bit of an in-between the line reading. So I'm far more subjective and don't hold back my own interpretation. And so if you want to have the cut and dry analysis, study the PDF itself and listen to Nick. And then if you want to get more input, then you're more than welcome to listen to what I have to say. And please give us feedback on this format, where this is a work in progress. See, on this first page is a summary of what the Fed's mandate is and so forth. And I'll skip that one, go into here what the Fed officials themselves think that the normal rate is for interest rates, the longer run rate. And so until and unless we are at that 3% level, there is a good point to be made that the Federal Reserve is still ultimately on the accommodative side. And so sometimes I say, even though rates have gone up, the foot is still on the accelerator. And that's because the neutral rate, one way to look at it, is about to be 1% plus 2%. So 2% the rate of inflation plus 1% is 3%. That is where the Fed would like to be in neutral territory. And to take one of my conclusions, I think the Federal Reserve rates are too low, and they will have to overshoot from the 3% side. And that also means that I do believe that not all rate hikes are priced in. Now, talking about what's priced in, the gray line is where rates have been. And then the black line is where at any point in time, the federal funds rate has been priced in to be in a year from now. And there's slightly different definitions used here for the Fed fund rates, and you can read it in details here. I'm not going to go into them in the small print. By the way, the blue analysis, that's Nick's analysis. And so if I disagree with anything that says there, I don't think this time around this happens much, but then just for perspective, that one is his and one is mine. And so one thing that I like showing and talking about is last year, 2017, was the first year in many years that by the end of the year, more rate hikes had been priced in for the subsequent 2-year period or so than at the beginning of the year. And in this case, what you see here is what is priced in for 2018 and 19. So basically where rates will be at by the end of 2019. And so that has gradually been going up. Indeed, even in recent weeks, been going up, although there's a little bit of a mellowing out here, tapering off here in recent days. But we are at substantially higher hiking expectations than we were at the beginning of the year. And some of that is, of course, the noise of the market. Keep in mind that the Federal Reserve's target is inflation, maximum employment. It is not things like yield curve inversion or other things. Financial stability, of course, comes in as well. I do think something like financial stability has to be seen in this context as well, because ultimately the Fed feels comfortable about hiking further until financial conditions will deteriorate. And I've mentioned this in other one of these slides, is the whole point of raising rates is to tighten financial conditions ultimately. And maybe to just be in a neutral rate for now, but at some point to maybe tighten conditions, and not much of that, if anything, has happened. These are inflation readings, and so the headline PCE, the Fed likes to look at the PCE, the Personal Consumption Expenditure Index, slightly different from the CPI index, but ultimately trying to achieve something similar, and looking at the core PCE without food and energy prices. And as we can see here, we're at 2% now. We have been going up steadily. We're at 2%. And so if people say there are no inflationary pressures, well, yes, not above 2%, but we are at a level where inflation is where the Fed would like it to be, according to its own saying. Now, obviously, the Fed would like it to be there over the medium term, so they may disregard what it's in on any one day. This here is inflation expectations. There are several different ways of looking at inflation expectations. And as you can see here, this is based on what the TIPS are saying, the inflation-protected securities versus the underlying treasuries. And there we can see as well, we're above the 2% level here. And so I'm not suggesting there's anything alarming here as far as the high end is concerned, but we're certainly no longer in that era where inflation expectations were depressed. Now, at the same time, yes, the Federal Reserve has a target of having, quote unquote, maximum, not maximum employment, but maximum sustainable employment. And the unemployment rate has been coming down, 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 down. Now, the question is, how many more workers are there on the sideline to come in? We have some charts on that. But very relevant is that underlying inflation pressures are ticking up. Now, it's not a straight line, but keep in mind, we have the foot on the accelerator, less so than before, but it's still on the accelerator. We have an economic stimulus. So both of those are on the fiscal side with the tax reform. And so both of those, in my view, are ultimately inflationary. The one potential headwind is trade, but trade barriers are also inflationary in the short term. And so there the question is, will the central bank shrug it off or not? But to me, this plays very much into my scenario, which is an overheating type of scenario. Here are several different ways of looking at unemployment, including the folks who are discouraged workers and so far. So all these levels have been coming down. Janet Yellen loved to look at the JOLTS report, at the job opening and quits rates. So there as well, workers are happily jumping ship, so to speak. Also a sign of a healthy economy. And then here, one of the big unknowns is the prime age labor participation rate. And the question is, the folks in the 25 to 54-year-old range are the ones who are supposedly the more productive folks in the economy. And so we had seen a long-term decline, and that has reversed. And so a lot of folks at the Fed, and some others, are arguing that, hey, we can keep this economy in this very high mode, high growth mode, because there are workers from the sidelines that will continue to come into the workforce. And that obviously has been correct to an extent. The question is, how much can you do? One thing to consider is some of that is due to regulation. So when you have disability benefits, for example, you are more likely to be out of the workforce. And so we had several years where benefits were such that you had less of an incentive to go back to work. And so in a hotter job market, the incentive to work might be greater than the incentive to be on disability or to be sick. And obviously there are other factors as well, such as the opioid crisis that play in there. On this chart here, we are zooming in on the male labor participation rate in the prime age. And the key reason we do that is because it's in some ways a cleaner snapshot, because you have fewer other factors distorting the numbers. On the men's side versus the women's side. On the women's side, you have during different periods in history, some women are more at home, sometimes they're working more. And so if you look at just the male side, you have a tad more of a consistent picture of what's been happening. And what's been happening is that overall labor participation rate has been in decline in the medium term. One thing I had mentioned a while ago is I'm looking for that line to be crossed about the long-term trend line, which is just an ex-post line that we put in here. As a point where we think that Powell might be watching this closely. I am certainly watching this closely. If we break through this line, then I think that we are very near, if you're not, at the exhaustion point of that labor pool. That said, well, we were happily marching up, as we see this as a noisy data series, and the latest data point was on the way down. So we've actually moved further away from the long-term trend line, and there might be a few more months in there before we have inflationary pressures be more pronounced. I referenced financial conditions earlier. This is a chart that shows the financial conditions. First, the black line is again where the federal funds rate is, and the gray line shows how financial conditions are. And the lower it is, the quote-unquote easier financial conditions are. There are several different indices. We like this one, the Chicago Fed National Financial Conditions Index. And the short of it is, it shows that financial conditions are easy. And that's compatible with my saying that the foot is still on the accelerator. Also keep in mind, if you look at the 2016, early 2016 financial conditions deteriorated a tad, there, when the Fed hiked rates, recall this was when they first tried to get organized in this tapering and all that. We also had issues in the fracking sector at the time. There, the Fed got really spooked and said, oh my God. And remember, this is all an experiment. We've never had this big a balance sheet, never were coming away from the zero boundary. It's this dance to get away from the zero lower bound. And so they were freaking out. That's my interpretation. And backpedaled, so to speak, says, no, we're not doing this. And the key difference to today is that now as we hike rates, the markets don't seem to care. They shrug it off. And sometimes people say, hey, the Fed is going to lower rates the moment we have a correction in the stock market or a crash in the stock market. That might have been correct in the context of 2008, but what really happened in 2008 was financial conditions deteriorated, and risk assets, such as equities, reflected that. And the reason why I think that's a key difference is that if the stock market were to tank, that in itself will not get the Federal Reserve to lower rates. What the Federal Reserve gets motivated by is access to credit in the banking sector. And so that's why it's crucial to look at what's happening in the markets in the context of these financial conditions. And there's, of course, the one anecdotal evidence that financial conditions have gotten tighter is the volatility we've seen in emerging markets, right? I mean, there's been plenty of coverage of that, but it hasn't made it onshore, so to speak. In the US, we haven't had those sort of trouble. And the US policy, if you look, is not about managing emerging markets. It is about managing the US economy. Fed balance sheet, here, the quantitative tightening, the reduction of the balance sheet is accelerating. And this is just in the context of the Japanese have been printing less money. The European Central Bank is phasing out, or is indicated to phase out its printing by the end of the year. There's no certainty on that, but that's the expectation right now. And then, as I do this recording, which is on Monday the 24th, Mario Draghi came out and cautioned about more inflation. Now, that's hugely relevant. It was just a few days earlier where the European Central Bank reiterated its inflation outlook of 1.7% for the Eurozone for this year, next year, and the year thereafter. And now a few days later, Mr. Draghi is revising that. That also means that interest rate hiking expectations for the Eurozone, at least for today, were substantially revised higher, that rates might be going up sooner. I've been arguing for that for a long time. In the Eurozone, if you think about it, you've got the US stimulus. That has a spillover effect. You have fiscal policy that's expansionary in the Eurozone as well. It's not just my take. Mr. Draghi has said so himself. The reason why why Draghi, in my view, has been talking rate hikes down in the past is precisely because they want to keep the spreads narrow for the weaker Eurozone countries and want to continue to boost economic growth. And so he's been using, quote unquote, every excuse that there is, from Brexit to global trade and whatnot, to say, hey, we're going to be cautious. Now, in the US, sure, trade policy is an issue, but keep in mind, trade is a very small portion of the US economy. And so from a larger perspective on the economy, trade doesn't matter quite as much. Now, mind you, it can have a negative impact, but the Federal Reserve's job is not in the business of thinking about what might happen. They do have to look at the data a little bit. And more importantly, Mr. Powell is a lawyer. And that means, in my book anyway, he doesn't have his own monetary policy agenda. Bernanke had his view on the Great Depression. Yellen is a labor economist. Powell is a bureaucrat. Now, I don't mean that negatively necessarily. Mr. Powell is a very intelligent person, but as a lawyer, he'll follow the process. That means he'll call for committees, he'll get people's opinions, and then he'll make a judgment. And of course, now as he's been in business here in his job for a little bit, we're starting to see how that works. But in my book, it means he'll be slow. He'll be slow to act. And so he wants to see financial conditions to deteriorate. And he has indicated as much. He will march steadily on and continue hiking rates. My view is that the inflationary pressures are going to increase as he's hiking rates. And so he will at some point be faced with this challenge that that inflationary pressures are significantly above 2%, and he has to continue hiking. And by the way, he will get some interference from our commander-in-chief that it's inappropriate to hike rates further. And I've indicated before, if the president makes such comment, it doesn't matter, because the cheapest policy is one where the Fed can move the markets with words, can set expectations. And when it gets torpedoed by somebody of influence, such as the president, then they might just have to do more than they otherwise have to. So they might have to go higher with rates than otherwise. And I'm not suggesting dramatically higher, but it is not helpful for monetary policy to get the political meddling. Here are the dot plots and I leave it up to you to study those. Plenty of other people are commenting plenty of that, where we're going to be in the long run and so forth. Here are some economic forecasts. Where these are the folks at the Fed where they think things will be. And one of the reasons I skip over them fairly quickly is because I'm not saying they don't have a clue. They have some of them have research departments, the presidents do. The governments actually do not. But these forecasts are subject to very significant error. Who is at the Fed? Again, studied this offline. Several changes. Obviously, earlier this year, John Williams moved over to the New York Fed. And then we just a few days ago had the announcement that there's a permanent replacement for John Williams, who was previously in San Francisco, for Mary Daly to move to be effective October 1st, the San Francisco president. And she is focusing, at least the way I read her research, mostly on productivity. She's made several comments that suggest that she's going to be in the dovish camp. And note that Williams is here labeled in the hawkish camp. I had a chat with Nick, because I wouldn't put him there, but he's been hawkish, I guess, of late in recent months. Relevant here is that even the doves are in favor of hiking rates and now being labeled hawkish, I suppose. My view on that is it's precisely because those easy financial conditions that the doves are willing to continue in the rate hiking cycle. All right, well, these are Nick's conclusions. My conclusion is, well, it has been, I think, filtering through here, that I think that that inflationary pressures will come through here. The Fed will be coerced to move higher. And for investors, it means several things. One of the things we do at Merk is we can take positions on interest rates themselves, and get in touch with us if you want to learn how to do that. And so there's a very direct application of this work. The other one is, of course, we take a lot of effort what that means for the business cycle. We have another chart book on that, so I encourage you to look at these in context, because historically risk assets, including the stock market, have performed much better during economic expansions. And so this is one of the reasons you want to watch these things from different angles. At least we do that here at Merk, to get a nice, well-rounded picture of the economy. I couldn't let you go without encouraging you to read the disclosure. Importantly, go to merkinvestments.com/research, download the PDF, look at the other reports, listen to Nick's analysis as well, and read his analysis as well as to what we think of the Fed. And with that, give us some feedback, and I'll talk to you next time around. Thanks then.